Namaskar and welcome to Sansad Television. I am Vishal Dahiya and you're watching our show Perspective, where we bring you detailed analysis of key national and international issues. Today we're going to talk about RBI's monetary policy statement. Now, Reserve Bank of India has once again raised the repo rate. Monetary Policy Committee on Friday took a unanimous decision to raise benchmark lending rate by 50 basis points to 5.40%. This is the third hike of policy repo rate by RBI this year, after 40 basis points hike in May, followed by another hike of 50 basis points in June. Now, pointing out that consumer price inflation, or CPI, remains uncomfortably high and is expected to remain above 6%, RBI Governor Shaktikanta said MPC decided to focus on withdrawal of accommodative policy stance to check inflation. He also said domestic economic activity is showing signs of broadening and bank credit growth has accelerated 14% as against 5.5% a year ago. RBI has also retained its economic growth projection at 7.2% for the current fiscal. So to further understand what does today's monetary policy decision mean in general for the common people and for the economy as well, we are joined by a distinguished panel of experts. Let me first introduce them to you, beginning with Mr. Anand Singh Bhal is joining us. He is the former Principal Economic Advisor to the Government of India. Deepshika Sikkawa, Senior Editor, The Economic Times, is also with us. And so is Dr. Aruna Sharma, member of the Digitization Committee with RBI. Welcome, all of you, to Sansad Television. I'll begin with you, Deepshika, and let's start by understanding some key points. One, of course, is the hike in the repo rate, and that's a third hike. One question which rises here is that, this is the third hike. So why, consistency here? As the RBI governor was pointing out, the accommodative stance is something which the central bank is doing away with. That's one aspect. But apart from that, what are the highlights?
So, Vishal, one key thing which we have to understand here is that what RBI has done is the pandemic stimulus which was provided by RBI in terms of reduced interest rates, that has been done away with. So 5.4 repo rate is now more than the pre-pandemic rate. And the clear indication is that there is withdrawal of accommodation. So essentially, I think directionally what is being conveyed is that any kind of accommodation is over, and eventually I think the shift would be towards, a further tightening or just maintaining a neutral stance. If the inflation cools down as is expected, because commodity prices have begun to cool down, we can expect a neutral stance going forward. But in that sense, I think RBI, there was some criticism that, RBI is behind the curve. So RBI is actually sort of gone aggressive in this round because 50 BPS, though it's in line with expectations, but markets, the general view was that it would be probably within 35 to 25 BPS. So I think these are the key takeaways. And I think one very important point which the governor sort of has tried to convey in terms of the external sectors, definitely there are risks there. But like he said, our umbrella is strong, and he's listed out many factors.
Indeed.
And I think RBI is watching the external situation very carefully. And this increase in repo also takes that into account. So this increase also sort of takes into account, actions by other central banks, and will also address the capital flow situation and the pressure on rupee.
Okay.
So key takeaways there.
Okay. Dr. Aruna Sharma, how would you assess the decisions being taken by the MPC and the kind of, consistency which we are seeing from the past two meetings? This was the third one wherein the repo rate has been hiked. And as the governor also pointed out, the RBI governor, that clearly there are signs of, broadening of economic activity domestically when we're talking about. And on top of that, the bank credit growth has also accelerated.
Absolutely. And as you made mention in the opening remark, and very rightly pointed out by Deepshika, My take into this is that yes, this was the need of the day, looking at the macroeconomics at the global level as well. And this will sort of bring in the interest rates will go up for the deposits and more savings will happen. But then in India, our problem at this point of time is to have an enhancement in demand. And that is something we have to wait and watch, that even though the prices, wholesale price index is not something we are still comfortable with, and that will flow into the retail price index. So if we are not able to trigger the demand, the virtuous cycle of demand and economy will not start off. And this high interest rate may push whatever little money is there, and pandemic hit has been taken by the middle class and the lower middle class to a very big extent. They may resort to saving. So that is something which needs to be watched. Then another thing which I would like to highlight upon is that this is something which was the need of the day. And as a regulator, I think they had no other option but to resort to this. And that is what they have taken. But then another thing which is needed is, are the banks going to give more and more credit? Because the EMIs are going to go up, the credit rates have gone up, the interest rates are going up. Again, what I said, the first point, it is going to hit the demand. So the spending money which will be available in the hands of the people will be coming down, and that needs to be watched because Indian economy needs it. Second thing is, if you look at the rupee conversion rates, how it is having a hit, then definitely our export and import issues, how it is going to be handled with this kind of an enhancement in the deposits and the adverse effect it is going to have in the old existing bonds is also need to be watched. So in a way, there was no option but to resort to such harsh measures to go back to the discipline of pre-pandemic. But then the new factors which has come up with high inflation, high wholesale rate index, lesser demand by the hit of the pandemic, that will be adversely hit with this enhanced impact because of the enhancement of 50 basis points.
Okay, fair enough. Let me bring in Mr. Anand Singh Bhal here as well. Mr. Singh, inflation seems to be a cause of concern. The RBI governor has also pointed out, and that is also one of the target areas when RBI's Monetary Policy Committee is coming up with these decisions. So, from the point of view of both the central bank and the government as well, when we talk about tackling the challenge of inflation, how do you think should be the next few moves?
There's no denying the fact that the inflation rate, the consumer price index inflation rate in India is very high by any standards. Of course, globally, it's a phenomenon, be it the US, be it the European area, be it Britain, everywhere the inflation rate is shooting up to 7.5%. And these countries are normally used to inflation rates of 2%. India, the inflation rate between 7 and 8 of CPI is a cause of big concern, and the Reserve Bank of India highlighted it a couple of times in his topic. And the entire focus of this MPC committee of raising the repo rate is to bring down inflation, is to cut down on this accommodative policy stance. And, the way inflation is unfolding across the world through energy and food prices and a couple of these black swan events, the Ukraine war, the pandemic. So a very concerted effort has to be made to bring down the inflation. And the primary role of any central bank anywhere in the world is to bring down the rate of inflation through monetary policy, through controlling demand for credit, through controlling demand and supply of money. So the RBI has very rightfully taken its role very seriously and is come out, in a way, sort of all guns blazing by raising the repo rate and bringing in some other instruments to reduce the amount of excess liquidity in the system and to also keep an eye on the sort of excess reserves at other places. So inflation is a cause of huge concern, and the primary focus of this monetary policy is to bring down inflation, and that is the way it should be.
Okay. Deepshika, as you're also referring to it earlier, and it's now pretty much clear that for the past few months, RBI, the central bank's main motive has been to bring the inflation in check, and that's why we've seen this hike in the repo rate. But if you look at the other side of the story, and in terms of countermeasures being taken by the government as well, how do you think the next few moves of the central government should be? Because both of them will have to work in tandem with each other to tackle this issue.
Definitely, Vishal, and we've seen that how government has been sort of working with very targeted interventions. If you look at vegetable oil prices, or if you look at the duty changes which have been brought about, so RBI and the government have been working in tandem to address this situation. The government reduced taxes on the crude because obviously the global prices were so high. So going forward, crude has seen some cooling down. Other commodities are also seeing some kind of cooling down. Mm-hmm. So if you see going forward, RBI has already said the accommodative stance, is not going to continue. That is sort of done away with. So what we are expecting is if the inflation, cools down, and we are very hopeful about that happening. And there are signs that probably, if everything else remains fine, it will probably cool down. Then probably there may not be sharper hikes.
Okay.
But, going forward, the monetary policy of India would also be driven by certain external factors. Mm-hmm. A sharper increase in rates by other central banks, because that would be, that will have an impact on the capital flows, that will have an impact on the rupee per se. So going forward, the external sector would be one of the key factors which would go into deciding what the monetary policy is, how the monetary policy is going to behave.
Okay.
Because inflation definitely is one of the key concerns, but going forward, we see external sector also emerging as one of a more key concern going forward, because that also feeds into your inflation.
Indeed. And those external factors are what, Dr. Sharma, from your point of view, when we are trying to look at external factors affecting the overall economic situation, and in today's world, any economy, any country's economy cannot function in isolation. So how do you think from going from here onwards in terms of these external factors having an impact on our economic situation, and of course the challenge of inflation?
Very, very correct, because the economy is so interrelated today that you cannot sort of be isolated or insulated into the way you approach the issues and you go ahead with the issues. As the interest rates will be going up across the globe, and that is the mechanism which across the globes are adopting, that along with the oil prices coming down, I think this will be having an impact into the FDI and the FIIs. So we had a huge drawal of FDI and FIIs, which had an adverse impact into our rupee value, and therefore increasing our cost of imports where our balance of trade is negative, and therefore adding to the inflationary measures as we are moving ahead with it. So this is sort of getting all interlinked when we are moving. So if you look at it, the fall in the oil prices is going to be a positive factor, but the hike in the interest rate across the globe is going to be a negative impact when we are moving ahead. Mm-hmm. Then internally also, some of the policies were not very conducive, which had some adverse effects, like sudden hike in the export rates. So while we were looking for a good balance of trade or improvement, it had a jerk into the capacity or the positioning of much of the metals and the minerals and other activities which we had created in the external market. So in the sense, we are adding to the negativity of the balance of trade. So if you put inflation as center of the stage, then there is still a lot of things to be done, and all these related policies are to be watched so that they are working not counterproductive, but maybe like supplementary to each other. So the RBI has done its job. Now it is for the government and the policies which has to be completely conducive,
Okay.
so that the inflation is kept on check.
Okay, okay. Mr. Singh, your views there on, the measures which have already been taken by the government and further, can be taken or should be taken being in tandem with the RBI's monetary policy here?
The RBI, the central bank, is in a way controlling the demand through its hike in the repo rate. The central government, what it does is works on the supply side more at the moment. India's particular stance during the corona was to work more on our supply side constraints. So we worked on the Atmanirbhar Bharat thing. So the global value chains, the way it has impacted globally. So we focused on how to make our global value chains more resilient in the pharmaceutical sector, in the electronic sector, and what have you. So rightly so, the government stance right through the corona pandemic was also to focus more on the supply side as opposed to a largely demand focused approach by the developed countries. So in a way, that way, India is in a better position because inflation, maybe at the end, inflation is every time at the end basically a demand phenomenon. But the supply side also has to be tweaked and made more resilient. And the government of India, through its various schemes, through giving food supply free to the concerned people, so keeping the food prices down, working on the Atmanirbhar Bharat scheme, supporting the MSME sector, and tweaking the global value chains. We've already been sort of making our supply system more resilient, and that will have an impact on the inflation. And this combined with the RBI's focus on monitoring demand, I'm sure we'll be able to bring inflation down to a reasonable level.
Okay, okay. But Mr. Singh, when we're talking about the external factors, and as both Deepshika was referring to it, as well as Dr. Aruna Sharma, in your views, what should be the key areas or key factors which, we should keep watch out for in terms of how it impacts us? Although RBI has retained the economic growth projection at 7.2%, but at the same time, the IMF is, projecting recession in major global economies.
True. So, see, the first thing, we should not bother about the exchange rate of the Indian rupee touching 80. See, the exchange rate of a country depends on the relative growth of your GDP and the relative inflation rate globally. So, that happens and the exchange rate comes out of that. So, to say that India has grown weak because we are touching 80 is a total sort of economic fallacy. The exchange rate is a natural outcome of your domestic GDP growth rate and the inflation rate in the various global economies. So that is not a cause of concern. Of course, look at our exports. Our commodity exports are doing very well. Service exports, as it is, does well. And the RBI governor said our current account deficit of whatever 3 to 3.5% is very sustainable. So it is not a huge cause of concern. Of course, we should focus on our export of goods and services, which we are doing. And under the very strong sort of push by the Ministry of Commerce and Industry, our exports are doing reasonably well. And so the one point I would like to make, this big hue and cry about India's exchange rates touching 80 is not such a big thing at all. It's a natural outcome of the way things are happening. And I'm sure the Indian rupee will strengthen, and our foreign exchange, the balance of current account will come back to a normal, sustainable level.
Okay, okay.
Yeah.
Deepshika, do you agree with Mr. Singh there on the issue of exchange rates 1 and 2 in terms of what to watch out for, given the projections of recession in global economies as IMF is referring to?
Vishal, I definitely agree. And we've seen, if you look at behavior of rupee vis-a-vis other currencies, not just dollar, I think a more clearer picture emerges. So I think what Mr. Singh said is pretty correct. And in terms of what to expect going forward, definitely, as Governor also said, if you look at India, if you look at the fundamentals of the economy, and if you look at how, our recovery, this kind of signals we are getting, what the indicators are talking about. So if you look at those indicators, they've been pretty robust. So if you look at GST consumption, the consumption story remains strong. And I think, of course, the globally things are sort of the global developments. There are concerns around there. But if we are able to sustain the recovery going forward, and the export sector definitely needs some attention, because we've seen the impact of what is happening in the global economy on the exports. The growth rates begun to slide. And I think that has concern the government also, and government is looking at what kind of measures can be taken for the export sector. So I think going forward, a very focused, very targeted policy for export would probably help us tide over whatever is happening in the global economy as well. And if we can ensure that our own recovery, our own economy growth sort of sustains and remains, positive on this path.
Okay, so there it is. Thank you so much, Deepshikha, Mr. Singh, and Dr. Aruna Sharma as well for sharing your views and insight. As our experts were also referring to, in the RBI's monetary policy, the MPC has clearly decided to focus on withdrawal of the accommodative policy stance to check inflation, and the overall economic growth activity is showing a lot of positive signs, and the RBI's projection, in fact, is again at 7.2% for the current fiscal. There are external factors which are a cause of concern, but those are being looked into, as our experts were also referring to. We'll come back again with more details on this and various other interesting topics. Till then, keep watching Sansad Television. Thank you.